Hi everyone, Adrian here, mortgage broker based in Sydney. On this channel we talk about all things investment, lending and finance. And on this video we're going to talk about the RBA rate increase that happened just over a week ago. Now we've got this article up in front of us, we're just going to run through it and then we're just going to talk about what some things are that are happening in the market at the moment. So if we read this headline, big banks react after RBA increases interest rates for the first time in more than 11 years. All right, then we come down here, we have a look at the RBA increase went from 0.1% to 0.35%. So it went up 25 basis points. All right, not a lot of people are going to feel the impact on this, and let me tell you why. All right, you had record low fixed interest rates and record uptake of those fixed interest rates over the last 6 months before these rate increases came through. And what you've actually seen is that the fixed interest rates have gone up over the last 3 months. So on owner occupied right now up to 80% LVR, you can't really get a 2-year fixed interest rate on principal and interest owner occupied for less than 3.3% at the moment, when before this rate increase we were looking at owner occupied variable rates sitting anywhere around 1.89 and 1.99 at the moment. So there is at least a 1 to 1.2% gap to where the best fixed rates are. And if you want to talk about the major 6 banks, you're not seeing fixed rates under say 3.4 to 3.5% at the moment on owner occupied. All right, so a lot of people took up the 2 and 3 and 4 year fixes over the last kind of 9 to 10 months. So this increase isn't going to impact a lot of people. All right, and if you have a look at it, it says the average owner occupier with $500,000 worth of debt and 25 years remaining on their mortgage will see their repayments rise by $65 a month. Really, that's not going to impact you too much, but the main thing that you need to be having a look at is that this is only the first of many increases to come. So we are seeing most likely 3 to 6 increases over the next 12 to 18 months. All right, so normally what happens is the RBA goes hard in the first couple. So we might very well see one next month and one maybe 2 or 3 months after that. And then what they do is they sit for maybe 2, 3, 4 months to see, because there's a delayed effect between the rate increasing at the RBA level to the banks passing on that rate to then that hitting your hip pocket, okay, and your spending habits. All right, and they need that data before they make their next decision. All right, so you're going to see kind of the first 2 to 3 increases happen very quickly, and then you'll see a little bit of a delay to get some of that data in, and then they may very well go again. All right, so you're going to see like this 2 or 3 stage process where increases, delay, and then we may have 3 sets of increases, okay, depending on what the data shows. And with how high inflation truly is, because everyone's seeing that 5.1% figure for inflation, it's not the true inflation, because if you use the calculation methods that they used in the late 1980s for inflation, we would have already seen a month that's higher than 15% inflation. Okay, what happened was after the 1980s, the government and the RBA changed the calculation method for how inflation is calculated to suit their purpose. Let's be completely honest. And what they've done is they've changed it so much that we only see inflation right now at 5.1% when true inflation is over 15%. Okay, so that means that we've already had a month that's worse than the worst month in the 1980s. Okay, so you had the 60s and 70s, all the policies created an inflation tidal wave that hit us in the late 1980s where interest rates went up to 15 to 20%. Okay, they could do that. And the reason why is that the mortgage at that time, and I'll use Canberra as an example, the average property in Canberra was between 60 to 100,000 in total in the late 1980s, and the mortgage on that was a minimum 20% deposit to 25% deposit mortgage. Okay, so if we want to average it out, the average mortgage was around, say, $60,000 to $70,000. Okay, so an interest rate rise of 10 to 15% really didn't hit the hip pocket too much, especially when the average wages at that time was $20,000 to $30,000. Okay, so the multiple on that mortgage was a 2 to 3. Okay, it's very different now, where especially in your Sydney and Melbourne's, it's very common inside of a 20 to 30 kilometre ring of the main CBD to have properties between $1 to $1.5 to $2 million. And there's a lot of people that are owner-occupiers in that sector of the market. Okay, so if you just want to pick out that market, you're looking at owner-occupied debt levels of over $1 million. Okay, and most of the time, the multiple on that mortgage for income to the debt level is normally around a 6, maybe a 7 sometimes for people stretching their mortgages. Okay, so it's almost 3 times as bad, 3 times hitting you as bad as the late 1980s. All right, so you've got record debt levels sitting at the government level. So if you add up all the debt sitting on the state levels and the federal levels, we're sitting on over $1 trillion worth of debt in the Australian market right now for the government. And then you've got household debt at record levels as well. All right, so everyone's saying that rates could go up to 5 to 8% is ludicrous. Okay, because if rates went up even 1 or 2%, so this is at the RBA level, not at the bank level, the whole country would implode. And let's talk about this other fallacy that a lot of people are talking about, especially brokers that don't understand how things actually work in the real life. So I'm seeing these brokers, they're putting these comments up saying that there's nothing to be worried about. When we're assessing mortgages, banks stress test them at 2.5% to 3% above the rate that they're actually paying to make sure that they can make repayments at the higher level, which is correct. Okay, but what they've then done is applied that to people. And we all know that people don't act like computers. They act like people. So what happens is, if interest rates go down, you have a situation where lifestyle goes up. All right? And if people have a certain lifestyle, is it very hard for them to reduce that lifestyle? Absolutely. Okay, so you got all these people that have increased their lifestyle. They've got in their SUVs, they've got in their property, their kids are in private school, they take their holiday a year, they rack up their points on their credit card, everything like that. Their spending habits they've got that little bit extra. All right, and what they've done is they've increased their lifestyles over the last 5 years. All right, and if you have a small increase like this, human nature is that we just change our lifestyle to match what the rate is on the mortgage. All right, but if that lifestyle has to change significantly, people don't change their lifestyle. They go into default, they go into arrears, they get into trouble. All right, so rates aren't going to go anywhere close to 3% up for a lot of people to be in trouble. It's human nature. I'm a mortgage broker. I look at bank statements every day. I talk to people about their living expenses. Okay, they think they're in control of it when they're not. Okay, let's be completely honest. I see the balance sheets. I see what assets they've got. Half of them have a boat now when they didn't need it. Half of them have 2 cars on SUV finance. They didn't go and get the practical 30 grand one, which suits their budget and where they are at in life. No, they went and got a 50 to 100 grand SUV. They didn't pay for it in cash. They got it on car finance. Look, I see it every day of the week. All right, so look, interest rates only need to go up maybe 1% to a 1.5% to really hit hard at the current levels. all right, the current levels of debt across the government and the household level. All right, so this is just the start. You need to be factoring in, 3 to 6 increases at a bare minimum. And just be aware, guys, that this is my personal view. All right, I'm not a financial advisor. I'm not giving you direct financial advice. I'm an investor, I'm a mortgage broker, and this is how I view the markets. All right, so if you're ever taking any advice or taking any action, you're always going back to your accountant or your financial planner if you're making big decisions, or you're taking what I'm saying with a grain of salt and you're going out there and you're doing your own research just like I'm doing and trying to get that good information out there. All right, so I hope that this video has helped. Hope that it has given you a little bit of guidance on, where interest rates are now, what the difference is in the inflation figures between the 1980s and now, what the difference is between the household debt levels and the government levels in the 80s to now, and really where the rates will max out at to really hammer home where they're going to start seeing the negative effects of increasing rates too much when debt levels are so high. All right, so we don't know where this train will end. Me personally, I'll be honest with you, I think we go up maybe 1.5% over a 12 to 18 month period. And then I think the government and the RBA truly sees how bad the economy is, that business hasn't recovered since COVID-19, the economics haven't recovered, the governments are starting to change their spending policies. They're not putting as much in to the markets anymore to stimulate the economy. And I think we're going to be in a situation where if they don't drop rates back down to almost neutral or negative very quickly, plus do a lot of printing or government policy which enables people to have liquidity and funds back in the market, I think that we're going to go into a very big recession, and I don't think the government will allow that. So I think we go through a little bit of let's try and control inflation, but then they find out that it's a runaway train. And then we're in a situation where if they don't put rates back to negative or very close to neutral, we'll be in a position where a lot of people are going to be impacted, and we're going to have a very big recession, which I don't think the government will allow. Okay, so that's my personal view, and you need to have yours, so you need to research yourself on the market. Okay, the interest rates are going up over the next kind of week, with a lot of the banks applying those rate increases. So we'll see how that impacts things, but just bear in mind you should be budgeting for at least 3 to 6 increases over the next kind of 12 to 18 months in my personal view. All right, hope that you've enjoyed this video. Hit that subscribe button, hit that like button. Okay, leave me a comment, and we'll see you on the next video. All right then, bye.